Hello, I'm Kyle Rodder. Well, how do we position ourselves in a bear market? In this week's Investor Spotlight, we look at the areas of the market that are performing and outperforming and ask whether there are still opportunities in a bear market. Well, to help me answer these questions today, I'm joined by my colleague Danny Akuye from Ausbiz, of course. And Danny, is this a typical bear market?
That's a really good question. The commentators love to just make broad-based statements about what a bear market is. So typically they say it's when markets fall 20% and volumes come down substantially. And basically that's what we had last year, certainly for the S&P 500. And we have had a massive contraction in volumes. But as per usual, you have to look under the surface of what an index is actually doing to work out that there are pockets of the market that are very much in a bear phase, and then other pockets of the market that are doing really well.
So we'll talk about some of those pockets in just a moment, but is this an interest rate story? And if it is, how does interest rates affect equity valuations?
Yeah, great point. So typically when interest rate rises come through, there's at least two impacts on markets. The first one is that the cost of capital goes up substantially. And basically that means that equity valuations continue to come under pressure because investors, instead of having TINA, there is no alternative, suddenly we have other alternatives. And for many investors, they've never seen this other alternative, which is basically cash in the bank. And imagine if you've got the scales, and the scales are saying, well, my share price might go down by 20%. Alternatively, I can pop my money in the bank and achieve a 3 or 4% return. Or if you're in the United States and you have access to money market funds, you're getting upwards of around 6% at the moment. So the first impact is on the valuations of the shares. Typically what happens, it's longer dated assets that get very heavily hit because they are the most sensitive through the models of how you value the companies to interest rate rises. And that's because people use discounted cash flows. We don't need to go there into all the technicalities. All we need to know, longer dated assets typically are more hard hit by rising interest rates. Think technology, what happened up until October last year. The second aspect is rising interest rates impact cyclical companies. So we know central banks increase interest rates because they want to slow economic growth. And in this case, they want to kill demand because they want to get inflation down. That means cyclical sectors, those that are very impacted, are going to be, their earnings are going to be hurt the most. And typically you would see that across the likes of the industrials, you would see it in the likes of the finance sector, because loan growth starts to slow, and the likes of the property sector.
Indeed, and we'll just get a chart up now of the ASX 200's financials and materials index. You can see it there. But let's just sort of speak a little bit more broadly for a moment now, because we can see cyclicals are underperforming, but over the last few weeks, we've had this AI theme coming through. Tech stocks are actually doing pretty well, especially in the United States.
Yeah, that's a really interesting phenomenon. So you have to now separate out, and this is where it starts to get a lot more complex, is where you have long-term secular themes which can actually create earnings growth through the cycle. Okay, and the AI theme is one of those. And the other theory that I have, which is correlating to what we're seeing in the bond markets, okay, and in the bond markets we're seeing longer dated treasury yields are much lower than short dated, which is indicating that the bond market, which is by far dwarfs equities, is indicating that interest rates are going to trend down. Okay, if interest rates, they think that's going to happen, for some reason central banks are going to have to pivot because a recession comes or we have a full-blown financial crisis, then we are going back to what a lot of investors would identify with, which what happened in previous cycles when central banks drop interest rates and longer dated assets start to perform. So it's a very interesting phenomenon that we're seeing this cycle, which does have similarities to what happened in the run-up to the dot-com boom.
So let's just try and put a little bit of a bow on it now. And what's the key takeaway? Is the message here that, well, ultimately this is not just a stock market, but is a market of stocks and should be, I suppose, invested in that way?
Absolutely. I think that whole premise, if you just buy a passive fund or you buy an index and you just sit there, clearly that hasn't worked in 2023. And at some point it'll be time to really come back and buy those cyclical stocks. And therefore, you really need to know your stocks. And interestingly enough, if we look at the flow of funds when it comes to those ETF products, they have been differentiating between the sectors, between fixed income assets. And I think that investors need to understand we live in a dynamic, ever-changing world, and it is a market of stocks, not a stock market. So knowing your sectors at the very least will help you, but also knowing your stocks.
Danny, years of wisdom condensed into a couple of moments' time, so we appreciate it. Danny Akuye, my lovely colleague at Ausbiz. Okay, well that's this week's Investor Spotlight. Join in every week and we'll take you through all you need to know in the world of global financial markets.